Hello, I'm Cody McKeon, and you're tuned in to YW2 with Alchemist Capital, where we talk about real estate investing. This video is tailored to either passive investors looking to diversify your investment or an active investor looking to grow your knowledge alongside me. Today, we are introducing the fascinating world of multifamily real estate syndications, an investment that could be an addition to your portfolio. Multifamily real estate syndication is a powerful investment strategy, but what does it actually mean? Simply put, it's a method where multiple investors pool their financial resources together to invest in properties that are larger, more valuable, and potentially more profitable than what they could afford individually. This opens up an opportunities to structure deals to invest in commercial buildings, large apartment complexes, and more. So you're probably wondering, how does this whole thing work anyway? Let's break it down to bite-sized pieces. Multifamily real estate syndications revolve around two main players: the sponsors, sometimes called syndicators, and the investors. Think of them as the captains of the ship and the passengers with treasure chests, respectively. In the roles of general partners and limited partners, our sponsors navigate and manage the venture, while our investors fund the journey. The captains, our GPs, steer the ship through acquisition management and eventual sale, pocketing fees and profit shares along the way. They earn through acquisition fees, asset management fees, profit splits, and IRR hurdles, ensuring they're rewarded for their expertise and successful management. But what about our treasure chest holders, the LPs? They're not just along for the ride. They're integral to setting sail. They invest capital, which goes towards closing costs, renovation, operating accounts, debt organization, fees to GPs, and the loan down payment. Their investment is the wind in our sails. But how do they see returns on this investment? LPs enjoy a preferred return typically between 6 to 9%, which can be either compounding or non-compounding. This is their minimum return threshold, ensuring they get a cut of the loot before the spoils are divided further. And here's where it gets interesting. Once the preferred return is met, a profit split occurs, often starting at 70-30 in favor of the LP. With the introduction of IRR hurdles, such as when the IRR reaches 13%, the split can adjust to something like 50-50, encouraging the performance of our voyage. Most importantly, the LP's ownership remains undiluted, even in the face of refinancing. Refinancing efforts are aimed at returning all capital plus the preferred return to LPs before GPs can take share in the economics. This ensures that the investor's share of the treasure isn't diminished by new financial maneuvers. The journey of real estate syndication is supported by a crew of professionals, including brokers, accountants, property managers, mortgage brokers, attorneys, including security attorneys, consultants, and the asset management and acquisitions teams. Each play a vital role in navigating the treacherous waters and ensuring a profitable voyage. LPs set sail with expectations of cash-on-cash returns, strong risk-adjusted returns, and a high ROR, taking into account the compounding time value of money. They also look at gross IRR before fees and promote to the sponsor, net IRR, and yield on cost to gauge the success of their investment. Understanding the market and setting benchmarks is crucial in charting a course forward lucrative of returns. And there you have it, a thrilling adventure on the high seas of real estate syndication, with every player contributing to the voyage towards treasure-laden shores. In our upcoming videos, we'll dive even deeper into the waterfall structure, return expectations, and how we navigate the market currents to maximize our treasure chest. The beauty of real estate syndication is in its strength in numbers. By pooling resources, investors can share in the profits, otherwise known as promotes and cash-on-cash returns, from property investments that would be out of reach on their own. As a passive investor or limited partner, it's a way to get involved in the real estate market. enjoy the benefits of property ownership, and not have to worry about the complexities of managing the property. But what makes a property investment truly lucrative? The answer often lies in its cap rate, or capitalization rate, a key metric that helps investors evaluate the potential return on an investment independent of financing. It's calculated by dividing the net operating income of the property by its current market value. Speaking of NOI, this is the lifeblood of property analysis, representing the total income generated by the property minus the operating expenses. It's a clear indicator of the property's financial health. Analyzing a property goes beyond numbers. It's about understanding the market, the property's position within it, and its potential for growth. And here, the sponsor or general partner plays a crucial role. The sponsor crafts GP relationships, securing principals to guarantee the loan, sourcing the capital, and building relationships with brokers to find off-market deals. They're at the helm, managing property management, adjusting the financials, nurturing investor relations, executing the business plan, and deciding when it's time to sell or refinance. They assemble the team, find the property, raise the debt and equity, manage the operations, and ensure distributions. Accounting and communications are all handled seamlessly. They collect fees and are allocated performance compensation or profit participation in the deal structure. Coordinating with attorneys for partnership agreements, traveling to the property, and taking on asset management duties, including lender conversations, comparing actuals, looking for discrepancies, and conducting performance reviews. On the other side of this partnership, the LP puts forward the capital, reads reports, and conducts due diligence on the sponsors and the deal. LPs have the flexibility to invest through IRAs, 1031 exchanges, and more. They can either be accredited and/or sophisticated investors, providing feedback and keeping track of their distributions. This symbiotic relationship between LPs and GPs is what makes real estate syndications such a powerful investment strategy. It allows individuals to participate in ventures of scale and significance, enjoying the financial rewards of real estate investments without the need to become experts in property management or market analysis. And so, through the collaboration of sponsors and investors, real estate syndication unfolds as a journey of partnerships, strategy, and financial acumen, leading to the exploration and realization of substantial investment opportunities that might otherwise remain beyond reach. It's a world where the combined strength of numbers and expertise opens doors to lucrative investments, offering both the thrill of the market and the stability of tangible assets. Now, embarking on this adventure, it's important to remember that, like any treasure hunt, it's not without its perils. These can range from market risk and management risks to the inherent illiquid nature of real estate investments. This is exactly why it's crucial to conduct thorough due diligence, to truly understand the syndication deal structure, and to assess the track record of the syndicator leading the expedition. Let's talk about the property cycle, which includes the growth phase, mature phase, and decline. The phase a property is in can significantly impact the investment's outcome. And then there's the market the property is located in. Not all seas are safe to sail after all. Factors like the economy and the interest rates play a huge role as well. They're like the weather conditions we need to navigate in. Another key crew member in this journey is the property management company, steering the day-to-day operations of our ship. And let's not forget the unforeseen hazards, such as environmental challenges, which can come out of nowhere, testing our resolve and readiness. As a new syndicator, my team and I are committed to reducing these risks for our investors as much as possible. For instance, if the preferred return isn't met at the end of the month, the amount owed will not just sit there, it'll compound. This means shortfalls in the preferred return are not simply set aside. They're accrued with interest at the preferred return rate. This is our way of protecting our investors in the event that cash flow distributions fall short of preferred return. At the start of our journey, regardless of the economic cycle we find ourselves in, we'll assess the risk associated with the asset class we choose to purchase. There are 3 cardinal rules we swear by, as well as other real estate syndications. Buy for cash flow, secure long-term debt, and maintain an adequate cash reserve. Think of these rules as our compass, guiding us through turbulent waters, ensuring that we not only seek out treasure, but also safeguard our voyage from unexpected storms. Our goal is to make this journey as rewarding as possible, understanding the risk involved and navigating them with precision and care. So, as we set sail on this exciting venture, we're not just aiming for the horizon, we're preparing for all eventualities, ensuring that our ship is sturdy, our crew is skilled, and our treasure maps are accurate. Welcome aboard the thrilling world of real estate syndication, where together we'll navigate the high seas of investment, seeking out the riches that lie beyond the risk. And there you have it, a brief but enlightening introduction to the world of real estate syndication. Whether you're on the lookout to broaden your investment horizon or simply curious about new opportunities, getting to grips with the basics of real estate syndication is an excellent starting point. For me, this journey has blossomed into a newfound passion for economics, private equity, private debt, venture capitalism, and really all things money related. This video serves as just the beginning, an introductory glance at the real estate syndications as a compelling alternative investment. It's not a deep dive into executing business plans, analyzing deals, or underwriting properties. That's a voyage we'll embark on together in future videos. So, if you're eager to learn more about how to evaluate a syndication deal and navigate the intricate world of real estate investments, make sure to subscribe and hit that notification bell. You won't want to miss what's coming next. Thank you for watching, and I look forward to continuing this journey with you in our next video.